Hi, it's Neil here, and we're back again, and we're looking at hedge accounting in international accounting. This is chapter 7 of the Dopich and Pereira textbook. I love this textbook because it's dated 2015, and it's always added value to buy a textbook that actually is written and released in next year, which is really, really good, isn't it? Buying it before it's actually released. So we're at chapter 7, page 364. I want to go through more clear terms what this example means. And this is an example of a multinational, a US multinational that makes sales to Europe. And how do you actually account for that foreign transaction? And how does that work in the accounts? And then we're going to think about, okay, how does hedge accounting fit into that balance? But before we do that, let's have a look. Or hedge accounting is all about using a forward contract or an option. And basically the difference is that an option is kind of a one-way protection. And sometimes you can let an option expire. If it goes against you, if it's on your side, then you might take up that option if it's in the money. Whereas the forward contract gives you both sides protection. And so the whole purpose of hedging is not to make any money in terms of a foreign exchange or foreign loss. Your whole purpose of hedging is to actually minimize any foreign exchange gain or loss. And I know that a lot of companies out there may well think that, hey, wouldn't it be good if we can keep that foreign exchange gain if it's there, like an added benefit? No, most multinationals are not in the business of speculation on foreign currency. So that's the reason why we have a hedge. A hedge is to stop the speculation. Most companies are in the business of making something and providing a service, but not speculation on foreign currency. So we need to have hedging, and most multinationals have a Forex department where they're actually entering into forward contracts, they're entering into options in order to protect the company against future variations in any foreign exchange contracts they are working with. So let's get into some of the examples in chapter 7. We're a US dollar company and we actually make a sale to Europe, and that sale is in euro. So we've got to use the euro sign, and it's $1 million. Very interesting. Let's get this information down. Now, at the time of making the sale, we have a exchange rate of 1.5 euro, 1.5 US dollar, and 1 euro equals 1.5 here. We've got 1 euro equals 1.5 US dollar. That means if we were to make a sale, and this is in December, if we make a sale in December and we actually sell $1 million and we receive cash at the time of sale, we're going to receive how much? We're going to receive 1 million euro. We're going to receive 1.5 million US dollars if we receive cash when we made that sale in the date of December. Okay, but you're not going to receive that cash for another 3 months. Why? Because you're a good company and you like to give credit to your good customers. That's why a lot of credit goes on. It's all about trade credit. It's the way you get sales. Customers may not buy from you if you cannot give them credit. If you ask for cash straight away, you may not get that sale. So to get this sale, we gave 3 months credit. Now, at the time of that sale, that 1.5 to 1, that's US dollar to euro, 1 euro equals 1 US dollar, the actual spot rate is 1.5, but the forward rate is 1.485 US dollar in 3 months' time. That's the 3-month forward rate is 1.485. Now think about it. Everything else being equal, there's no other changes in Forex. If we have a perfect hedge and we used a forward contract that locked us in at 1.485, we are going to receive in 3 months, if we have a full forward contract hedge, the cash would be, we'll receive 1.485 million. That's what we're going to receive in the future in 3 months' time. Now, as it turns out in the example, the actual spot rate in 3 months' time turns out to be 1.48 US dollars. And at the end of the day for the example, and we'll look at some of the debits and credits in a minute, at the end of the day for the example, we actually, by going into a forward contract that locks us in today in December, by the time we get through to January and February, the 1st of March, okay, even though the foreign exchange rate has gone down to 1.48, we've actually locked in 1.485. We've locked in this amount here by using a forward contract. So that's what we mean by having a forward contract in place. We're able to lock this in because this was the amount in December that we could actually purchase these euros at, or the US dollars at, with those euros. Now, how does that look in terms of accounting? I'm going to have a look at this in a minute. So in basic accounting, you want to think about it. If we haven't got a forward contract, we're basically going to have accounts receivable. And we're going to have sales. We make a sale. Now, what were those sales again? Those sales, remember, we're talking about US dollars, because this is the US multinational sales account. They made €1 million sale, and so they expect that is the amount of the sales, and the accounts receivable is an asset. In other words, you're going to receive this in 3 months' time. You're going to actually receive $1.5 million US in 3 months' time. Well, we hope to, okay, if the foreign currency exchange rate does not change. Okay, now what happens in 3 months' time? Then, if nothing else changed, you're going to get 1.5 million in, and then we can start to have our cash, and it comes into cash. This is executed out. Then we have our cash, and so we get 1.5 million into our coffers here, and basically the sales, that's closed off to the profit. So the net income is increased by 1.5 million because of that, was for that one transaction. Now that's not even considering any foreign exchange changes, and I haven't done any conversion. This is your basic sales accounting, where first you're actually creating accounts receivable, and then you bring it down to cash at the end of the accounting period, and of course sales closes off to your profit and loss account. And so we're closing off, and we've got revenue in the profit and loss of 1.5, and we've got more cash. We've got more 1.5 million US dollars more in the bank. So this is your basic calculation without any Forex. So there's actually, in terms of Forex accounting, there's no Forex accounting to worry about, okay? So how is Forex accounting different from this basic accounting? So basic accounting, number one, this is your first entry where you're making a sale, and then you're creating an asset, that's accounts receivable. Then in the future, when you receive it, you receive the money, it goes into your bank, and then you close out the sales to your profit and loss, okay? So therefore we got 1, 2, 3 steps. No problem. Okay, so how is Forex accounting a bit more difficult here? Well, we're working with an extra account, and that is a Forex gain and loss. So let's have a look at how Forex accounting is. We've got our sales, and we've got lovely sales. We're still hoping that we will get 1.5 million US dollars. We hope we can get that. We do. All right, then we've got our accounts receivable. Now remember, we're booking this at the current exchange rate, which is the spot exchange rate, 1.5. That is the spot rate. Okay, so this is our first entry. No difference under normal accounting. So now what happens at the end of the period? Well, over time, the spot rate goes down to 1.485. That's goes down to 1.48. Okay, so let's write this down. Here we go. We've got pens and things flying out. The spot rate goes down to 1.48 in 3 months' time. So in 3 months' time, guess what's going to happen? You're going to have a Forex gain or loss, Because really, you're only going to receive how much? How much are you going to receive in 3 months' time? Yes, you're right. You're only going to receive 1.48 million. So that's going into your cash. 1.48. That's how much is going into your bank account. Nothing more, nothing less. Yes. So what about the other 20,000? Because we've got to close this out. Well, really, what we've got here is a Forex loss. We've just lost 20,000 US dollars. We were hoping to receive 1.5 million US dollars. Now we only receive 1.48 million US dollars. Interesting. And so then at the end, they will close out. Of course, this will go to the other comprehensive income. So we've got our Forex loss, and then that can, wait a minute, we've got here to here, and then we've got our Forex. We're going to close this out over to here, which is a loss in other comprehensive income. And then we've got sales, 1.5 million here. That's going to go down in here into the P&L. Right, 1.5. But we've got this other income. This is the losses registered here, and sales is registered here. Now, depending on which accounting standards we're working with, all of that 1.5 million can be adjusted by this 20,000. So your net effect, the net effect on the profit and loss for the period is this 1.5 million minus this 20,000. Okay, now what we want to do now is, this is basically without hedging. This is a basic Forex transaction where, what is the new account? This is the biggest new account that we need to think about, which takes up the slack of any difference between the spot rate at the time you entered in the transaction and the spot rate at the time you actually received the cash, because this takes up the slack of cash you're expecting to receive, that is the 1.5 million, and the actual cash you did receive, the 1.48 million. The 20,000 is going into this account here. And this is the account where you're registering a Forex gain or a loss, and then you close that out. Depending on if you're following IFRS or if you're following GAAP accounting, it's likely to go into other comprehensive income, and of course the rest can be closed out to profit and loss. But then this needs to be closed out at some point in time. But that's not the point of this exercise. We're just trying to point out what happens when the exchange rate goes from 1.5 down to 1.48. Now, that is part B. So what I've taken you through so far is, number one, what is the basic entry for when you're making a sale? And then you close it out to cash and to profit and loss. Now you're working with a sale and you're closing out, but you've got a new spot rate that happens in the future that causes you to have less cash being received, because the spot rate of $1 is now worth only 1.48 US dollars. When you receive the cash, you receive 1 million euros, you're only receiving 1.48 million in US dollars. So the final part is there some way that we can create a hedge so we can protect some of this 20,000 loss? That's what we want to, this is the big issue when we're trying to protect. We're trying to create a hedge so we don't have to shoulder that 20,000 loss. Is there some way that we can sort of protect some of that? And yes, there is. And so let me just show you how a hedge might work. And so we're going through here. Rub this off. Rub-a-dub-dub. And it's getting grayer by the moment. I love this whiteboard. It's definitely grey. It's a grey winter's day today on the whiteboard. All right, so take three. We've got sales. All right, we've got our accounts receivable, and we're using a 1.5 spot rate. We've got 1.5. We've just made this big transaction. 1 million euro, it's wonderful. So we're expecting to receive 1 million euro in US dollar equivalent in the future. That is great stuff. But what we enter into is a forward contract. So what you have a look when you actually look at Forex rates is there's a spot rate, but the forward rate may be 1.485. So in other words, the forward rate is you can choose today to where weather all of the variance in the foreign exchange rate. Or you can decide to go into a forward contract where you receive 1.485 in the future, in 3 months' time. Okay, so that is your hedge. So you can think right now is this is not a perfect hedge. In other words, you cannot guarantee that you'll get 1.5 in 3 months' time, depending on how big a company you are and which bank you're working with. There's always going to be a margin where they make money out of that premium of entering into that forward agreement. So again, we've got our Forex loss, Forex gain loss, and we've got our other over comprehensive income, and we've got a forward contract account, and of course we've got a lot of other issues that are associated with profit and loss down here, and then we've got cash down here. Okay, and so what tends to happen is, and we've got what else have we got? We've got cash, and we need foreign currency. We've got another forward contract, and then we've got foreign currency here. And so again, now we've got our first sale, number one. Okay. Now what we're going to do now is that we receive 1.48123, and that's going to go down into foreign currency. All right. In some ways, what I showed you earlier, this is cash. All right, so we're going to bring this across to cash in a minute. Okay, we're going to bring that across. But what's important now is that now we need to register another 20,000 here, and that becomes a gain or loss, like we did before. 20,000, Forex gain or loss. Now, what is new here? And then that ultimately that will go into other comprehensive income. That's great. And also we've got the 1.48, it comes into foreign currency, and then we can close that out. We can close that out to the cash over here, and that is cash 1480123. Okay, so what happens before we start accounting for the forward contract here? We've still got our one, we've still got our booking of the receipt, which is going to foreign currency, and then it's going across to cash, which is number two, and we are still booking the loss. We're still booking the loss, number three. So that hasn't changed. But once we have a forward contract in place, at the time of the balance sheet period or at the end of the period, we're going to register a forward contract that really allows us to get another $5,000 in cash. How does that happen? Well, because we entered into a contract where it gave us $5,000 gain in here. You see, because we entered into a forward contract to actually sell US dollars at 1.485 in 3 months' time, we don't lose 20,000, we only lose 15,000. And so the difference between the 20,000 we would have lost and the 5,000 and the 15,000 we actually do lose is this $5,000, and that's booked through a forward contract account here, and then the rest of that goes down to here to cash. So we've got 1, 2, 3, and here's our big new entry here, which is 4. So let's, in summary, go back over what we're doing. Number one, we are making transactions into a foreign currency. We can choose to be risky. We can choose to speculate. Maybe the currency will appreciate, right? Maybe it'll go from 1.5 to 1.55. Wow, we not only make profit on the sale, but maybe we can make some money on the side too. Wouldn't that be good? But most companies are smart not to do this speculative activity, so they enter into hedges. And there are two types of hedges. There is a forward contract hedge and there is an option hedge. Under the forward contract hedge, what I've explained to you now is that the purpose is to try and protect some of that risk. You're not going to be able to protect all of it perfectly, but you can get some of it. And the entries I showed you here today allowed you to protect at least 5,000. of that 20,000 loss that you would have weathered if you had not have had a forward contract. So 5,000 is better than nothing. And when you add that up to hundreds of millions, billions of sales revenue, you can see that forward contracts can actually protect you from foreign losses that would otherwise have to be booked into your income. So 1, we got sale, we're registering a sale. 2, we're receiving money on the sale. 3, we are recording the foreign exchange loss. And number 4, we are making an adjustment for the forward contract that's in place. And a forward contract doesn't get booked at the time of the sale. The forward contract accounting happens at the balance sheet date or at the end of the reporting date when the actual transaction is closed out. That is, you actually receive cash on the transaction. So I know the textbook goes into a bit more detail about all these other debits and credits, but I think if you can keep in mind step 1, step 2, step 3, and step 4, that will be the best way to really understand the steps in trying to hedge your foreign exchange transactions. So catch her in the class. Keep in mind, hedge accounting, very, very important for multinationals working internationally. I've just given you an example of forward contract. Options contract are covered in the book, but we won't be covering them directly in the exam. Thank you, and catch you in the classroom.